Now let's go through the solution to this problem, and it's a simple one. It basically asks for you to prepare the journal entries for a number of events for a company called the Smith Company. In this particular case, on November 1st, in the year X7, the Board of Directors meets, declares a $100,000 cash dividend payable to the common shareholders with a date of record of 12/1/X7 and a date of payment scheduled for January 1st. Well, this is almost identical basically to the problem that we had during the lecture. Apparently there is no preferred stock in this particular case, because if in fact they were declaring a dividend and there were preferred shareholders, there certainly would be an allocation to them before any allocations of dividends to common shareholders. So in this particular example, apparently this company has not issued any preferred stock. All we're doing here is making sure we understand the entries again and kind of practicing the entries given the various dates associated with the declaration of dividends. On the date of declaration, we'll credit dividends payable because there now is a legal obligation to fulfill the Board of Directors' authorization and vote. The debit is to dividends. Call it dividends common stock, although it isn't necessary to distinguish it as common stock if there is no preferred. The second date is the date of record. This is the date in which the ownership is established for who will actually receive the dividend on the common stock. Who owns the common stock as of the close of business on December 1st? On that date, we will make no entry. There is no additional obligation. All we're doing is identifying who we have the obligation to. We've already recorded the liability. The next entry is that they request in this problem are the closing entries at the end of the accounting period before we start the accounting for the next year. To close dividends, we would credit dividends, common stock for $100,000, and debit retained earnings. Notice that the debit to retained earnings, that since retained earnings is an owner's equity account, a debit is a reduction to retained earnings. We increase retained earnings on the right-hand or credit side and decrease it on the left side. Dividends ultimately have an effect on retained earnings of reducing it, because as we distribute resources of the business to the owners for their personal use, we do not have as much resources retained in the business as a result of prior earnings. The final entry is as of the date of payment, which in this case is January 1st, the next year. The business actually cuts checks to the shareholders as of the date of record and credits cash for $100, debiting dividends payable.